You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
Welcome, everyone. It's Volatility Views, and I'm your host today, Jared Woodard. Mark Longo is away. We can't find him anywhere, and we're extremely concerned, but we figured we'd press on anyway. Just kidding, of course. Mark's he'll be back next week. But I'm Jared. I'm equity derivative strategist at BGC Partners. And joining me today, as most days, is my colleague Andrew Giovinazzi from the Option Pit. Andrew, how are you?
I'm doing fine. You know what? And do you ever think about Longo, like how often he disappears?
Yeah, I think he must have some other gig on the side.
I think so. I think the more that we host, the more he realizes that he doesn't have to host.
Yeah. So, but you know what? The good news is today he left us some really good questions from listeners that we'll be able to tackle. I'm excited about those, and we get to talk today about volatility in a context in which there actually is some in the market. So I think we should dive right into the volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
In this volatility review, we have a VIX trading right now quoted around 16, and that's up from a handle when we recorded the last show closer to, I think it was less than 12. Or maybe near 13. So we've seen a significant spike up in vol this week. And I think that between Thursday and then on Friday, it's anybody's guess as the causes. Maybe, Andrew, I'll let you start with that. Why do you think we've seen this move in volatility?
Well, you know, there's nothing like having the market drop a couple percentage points to get the volatility to start moving up. And one of the biggest problems, there was two things that was going on this year. One, we had some crazy skew for a long time, when the at-the-money volatility was so low. And what that normally does is that drives the wings relative a lot more expensive. So the skew reads real expensive. But the market wasn't going anywhere. It was only moving like less than 0.5% a day or 0.25% a day. It just was not volatile. And to be honest, I don't know why this week was any different than any other week as far as what made the market move. The Gaza thing is still yucky. The Ukraine is kind of yucky. Argentina's defaulting, but since nobody lends the money anymore, they're defaulting on stuff that they already owe people from, God knows when. Maybe the fact that the Fed's getting a little more hawkish in their comments, and, that's kind of their MO. They get a little more hawkish as time goes on, so the market kind of gets used to it. And maybe that was just sort of the sell-off we saw here over the last the last couple days. But we were trading, I think, 198 SPY at the beginning of the week, and we touched 191 and change today at this kind of probably like the low point of the day. And the volatility's picking up. And I just think, people are getting a little more, let's just call it, they're a little more worried, even though they really don't have anything more to be worried about this week than they did last week when we were trading 12.
Yeah, I think that's a great point. You hit the nail on the head there. I think we got a data release today. It was non-farm payrolls day. Personal consumption expenditures came out. Average hourly earnings came out this morning. All that data was, I think, about as good as investors could hope for, in the sense that, non-farm payrolls came in a little bit lighter than expected, but certainly was still, not the kind of level that you would associate with any concerns about growth. When you're adding, 200,000 jobs or so each release, you're pretty happy with that. But especially on the inflation side, the wages side, that, those numbers were flat to moderately higher with revisions. And so it's hard to make the case that, the Fed is going to feel any pressure from this data to pull forward their timetable, I think. So maybe if it was some positioning changes on Thursday that some people were getting out or trimming their exposure in a kind of a sloppy fashion, maybe today will alleviate those concerns somewhat. But it was kind of, I guess the big headline was the largest percent decline on Thursday of this week in many, many months. And by the same token, we saw the biggest explosion, I think, in VIX and implied vol in the VIX that we'd seen in a long time. So I guess it was unusual to see such a large move without any really obvious coincident change or cause, although it's always suspect to try to look for causality in these things. But to see such a big move without any real obvious catalyst, I think, was one thing that had people kind of off guard. Did you see the you mentioned the skew in volatility? I don't know if you watch the VVIX index that often, but that measure really kind of exploded up this week as well.
It did. All of it. I mean, it was over 100. We actually started to sell some call spreads yesterday, closed some flies today. It went. If you want to sell volatility, it's probably the better way when the vol's that high in the VIX. Normally, once it hits 100, it's hard for the vol to go higher, although the VIX can still go a lot higher. But that is a decent level. Usually, I would say, associated with a bit of a little bit of a panic. But I think there was a decent reason for it with the market. It's just the market's moving down, and when vol's so low, it has to catch up. And the move from 10 to, from basically 0.5% a day to 1% a day is, in percentage terms, is pretty big. So, but we are seeing vol increase across all the volatility products that I'm looking at, like VXX, UVXY, all the stuff we love to hate. Big spikes in volatility, a really, really, really backward term structure curve, or the VIX futures. We're backward all the way until January at one point today. We actually had some severe backwardation with the August future starting to trade above everything else early in the morning this morning. So there was a sense that we were going to see some more movement, and then I don't know what happened, but I think somebody blew the all clear whistle at some point. I think it was SPY trading SPX getting close to that 1991 or whatever the level is, and it bounced.
Right.
And I think what really happened, honestly, is there weren't any more reasons to sell. Like you said, with the data, they just ran out of reasons. Sellers ran out of reasons to sell. But you did see that super, super, super high volatility in like the VXX is trading into the 70s today. The IV30 is 75 in there, pretty high. So, I think it's ripe to sell. There's flies. There's things you could do to try to sell some of that upside premium. But, at least for now, it feels like things are starting to subside a little bit. And technically, I guess this will be, I don't know, like the third or fourth or fifth non-farm payroll report in a row where the VIX does drop after the report. Although it was a little higher this morning, it's come off. It's come off since then. So, we've got usually what I tell a lot of my clients who they like trading the vol products and volatilities, it's probably best not to make the first vol sell. I prefer to wait till I see vol actually start to move south from a higher level than trying to pick a top. It's just like trying to catch a falling knife with an equity going the other direction. We prefer to see a little trend going the other way. And, the fact that the vol's failing just a little bit today, it would not surprise me, if some of the implied volatility of all the products start to drift down here the last hour of the day or so, if that's what we get. I know everybody's listening to this on Monday, but you're probably going to see lower implied volatility of the vol products by then.
Yeah, this week was really interesting, I think, on a number of fronts. The volume in VIX options was extremely high on Thursday. I think we traded about 1.3, maybe a little bit closer to 1.4 million contracts, which was, I know, the highest since May of this year, since May 12th, I believe. So it was, some real volume behind the move in the VIX options. About 1.15 million of those were calls, as you would expect. Today, we're trading about 788,000 VIX contracts near the last few hours of the session. So, still quite a lot of volume as well. And Andrew, what did you see in terms of VXST this week?
We saw like there were some early buyers of out of the money calls in there, like 18, 17s, 19, stuff like that. 17, 18, 19. Not a lot, but, some. And, VXST is down about 24, trading 1835 right now, which is, a couple points higher than VIX because it's the short-term stuff. But I think that's the highest number we've seen for this since they listed it. I'm not positive, but I'm pretty sure that since it became a listed product, that is about the high. So it traded 20 today. So short-term volatility got up to 20. That's not too bad. And what's funny is, for a measurement for VXST, just to give you a little sense now of the product, 4 weeks ago, it traded at a low of 844.
Wow.
So it is starting to trade in some kind of a range here. But I think since we listed options, we just traded a high. So, you think about it, we were trading in the 10 handle last week in it, and now, we closed or traded in the 20 handle today. That is kind of bringing the action that we would hope would drive some volume. It drove a little bit of volume. It did not drive a lot of volume. I'm still seeing the volume on the day, and it, kind of light. This morning, the markets were all goofy. I was trying to get something done, look to get something done, but there just was no, I essentially was untradeable for a while in the morning. I just couldn't get any quotes on it. I don't know if it was just the vendor or a problem, but it's moving. I'd like to see a little bit more volume, but it definitely has that ability. But you have to catch it so right because you only have a month.
The volume on this has been picking up so much in July. I wonder what the experience has been for some of the investors who've gotten in on this. The daily volume has been, more than 2,500 contracts on a number of occasions. I guess we're in August now, but for July there was some pretty big days. Only a couple of those which were associated with large moves in the market, large moves lower, or large moves higher in VXST itself. So it may be that some of these trades were you don't know what side they were on, but you've seen some bigger volume this month, last month, and then it's kind of I guess unexpected, a little bit quizzical that finally when you get a huge move lower in the market and a spike up in vol, I guess we would have expected to see VXST get some really big adoption, but for whatever reason, it was just kind of a light day.
Exactly, and I think it's new, but you start looking at some of the movement. You get 100% move in the underlying in a week. Somebody's going to start watching it now.
Mm-hmm. Yeah.
And again, a new product, but when that vol gets real low, but you can see we stayed low for a while. But it is hard to, it's hard to say no to the fact that it was printing 8.5. Not very, not very long ago. And it should, because nothing was happening. But clearly today's a little different.
Yeah. Well, any other stats or things of note in terms of a review of the past week?
We did see a lot of call spreads go up today in VIX. The skew this morning got insanely. I'm not going to. Well, pretty steep for the product. August 1825 call spreads went up. Looked like buyers of those 30,000 times for 115 over 33 cents. So I think some traders just taking advantage of that. The high skew, you get relatively cheap call spreads in the VIX, and then maybe you can go sell puts in the SPY or something like that. Different things you can do when you can purchase, VIX vol so cheap, and then go lay it off somewhere else. So there was a little bit of interesting trade, but I thought, overall, the future moves were so muted. We stayed so backward for so long. Mm-hmm. You just didn't get that real explosion in kind of the underlying movement with the product that I was kind of hoping for. I mean, it worked out so far, but I thought we would have seen a little bit more, but we just didn't get that big jump in future premium that I was looking for.
Two interesting things on the skew front that I was looking at this week. In the first case, there were a lot of different single stock options that had. This was earlier in the week before the markets really got moving, but a lot of single stocks that had some fairly flat skew curves, where the out of money calls were priced near, or in some cases even above, the implied vols in some of those put strikes, and these were, I think, in names that had been rallying pretty hard, and so the expectations were presumably for some of that momentum to continue. But there were a number of names that were at some historical extremes, and then conversely, on the other side of things, on Thursday and then Friday morning, we noticed that the implied vol skew in the Russell 2000, looking at the ETF IWM, was at some of the highest levels in several years, where the puts had been bid up so much that the 25 delta puts and calls out of the money were at one of the largest spreads in several years. I guess as an indicator of just how extremely negative the sentiment had flipped as of Friday morning.
Yeah, it was really, really strange how fast things turned around. I think today you're not really seeing the big bounce. So I think we're back to looking for a weekend and looking for, where we kind of try to price the weekend in and see what happens on Monday. And we'll see if there's any real news usually there's a reason for a sell-off. I didn't really pick up a lot of reasons this week. So there was a reason why people were buying puts, where everybody kept trying to pick a top. So finally, 7 months into the year, they were right.
Well, with that, I think we have some good questions. So let's roll right into the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
So thanks, everyone, as always, for writing in. Eligo sent us a couple of questions, and the first comment comes from a listener, TiklenIvory, piano player, I guess, who asks, "What's the best way to short VIX? Straight up VIX puts, or to go long XIV?" XIV is a exchange traded note that gives you the inverse of the VIX futures, the short-term VIX futures index. Those are two ways. You could buy VIX puts. You could go long XIV. You could certainly trade VIX futures. Andrew, what do you think? What's the best way to short VIX?
Boy, that's a loaded question, huh?
Right? Yeah.
Actually, I was just pulling up XIV now. I think I wanted to add a little. I think it's where you are in the cycle. I think really shorting VIX using VIX puts works better as when you're closer to expiration and the futures are a little closer to the actual cash price. So you might actually get, a real move. When you get the real move, you actually could maybe make some money on the puts. But generally, it's in contango most of the time. So, puts are usually very cheap in VIX relative. The problem is you got to wait forever for the future to get down to the cash to actually make them work. So I prefer within 2 weeks of VIX expiration in the near term, at least, if you're going to buy puts on the VIX. Generally, if you have to wait too long, you're waiting for an awfully long time. The gamma is just so dead in there, making those puts move. It's tough. XIV, I like I said, as a product when the vol has started to turn a little bit. We saw a low this morning in that just below 37. Now it's trading around 38.5. I never have to catch the bottom with it, but, I like it after the vol has kind of already spiked. It's just, to me, as a trade. And then, when VIX gets back to, 10 or 11 or something like that, then I just close it. So again, for one, depending on where you are in the cycle, and two, what's just happened with volatility, that kind of points me to the different types of products. The only thing I would add is VXX is pretty decent for shorting vol, like the out of the money put time spreads. Generally, when the vol's a little higher in there, it helps pay for it until the product starts moving south. It's not a bad way to go. So, again, depending, with vol higher, selling call spreads is not too bad, even though you don't get paid a lot to do them. So, because the skew is wacky there. So I think really it depends on either where you are in the cycle, what's just happened with vol, where's implied volatility. And that tends to me to sort of pick the type of vol trade that I go looking for. So it's kind of condition specific that way.
Yeah, that's a good point. I mean, on that theme, you could even say that the question, if we were going to form the question really perfectly, we would say, what's the best way to short implied vol at this kind of maturity or that kind of maturity? I mean, I like to think of trading volatility sometimes as analogous to trading fixed income in the sense that you would never say, well, what's the best way to short Apple options or buy Apple options? Because you've always got to specify a time frame, or an expiration kind of a period. Just like in fixed income, you wouldn't say, well, what's the best way to buy bonds or sell bonds? Well, you've got to figure out where on the curve you want to be. And I think the same kind of principle applies when it comes to VIX. Even though the measurement window of the VIX index is very short, certainly you can trade futures going out many, many months. And I think that's one of the places where volatility traders find the most of interest is choosing the point in the VIX curve where they want to be. So for this example, you could go long XIV if you wanted to trade in the very front of the VIX futures curve. But there are exchange traded notes that are picked other places. ZIV is another popular vehicle that trades or tracks position involving futures in the middle of the VIX curve. And there's some really interesting dynamics that are worth exploring for choosing where along the curve you want to be. And so I think that's probably the best way to investigate what sort of strategy you want to pursue is what your view is about the nature of the VIX curve and where you think the most value might be in relative terms.
I like that, Jared.
Thanks. Well, we talked last time about straddles around earnings and about straddle volatility and some of the research or lack thereof around that. We had two questions about that for this week. One is from James Forrest, who says, I like the conversation regarding straddle volatility going into earnings. I agree there should be more research into this area. Jared, I'd happily add my $5 to the mix if that will spur you into action. Wasn't sold. Okay. If you had to guess right now, what percentage of Fortune 500 names, what percentage do you think outperformed their straddle in any given quarter? James, yeah, so that $5 will get me moving, and I'll see what I can do. But in the meantime, this is a really great parlor trick or parlor question, I guess, if you're among options traders. So what percentage of, let's say, S&P 500 names do you think outperform their straddle in any given quarter? I presume that means, Andrew, that if you buy the straddle ahead of earnings and hold it through the following session, how many times would you come out ahead? Do you have any intuitions about that?
I'm going to say like 50-50.
Yeah, me too. It seems about right. If we're going to be sector neutral, well, I guess large caps are going to be a little bit less likely to move than, say, if we were doing Russell 2000 or.
See, the thing too, don't forget, is the large caps. Just so we had a strategy-led trade today that we closed for Procter & Gamble. So the September at the money straddle actually was trading for about the average price, just slightly above, like 25 cents above or so. The average price, the last four earnings moves. So, as a trade, I'm like, you don't have a lot to lose there, even after the vol crush coming in. And actually, it was kind of a little home run today. It ended up being nice. But I think people forget, what you're paying for the straddle. Like when I was a young, market maker, I learned really fast. It's like the other person can have the position as long as I get to pick the price. And as a market maker, that's kind of what you learn early on if you're going to survive for any length of time. So I think a lot of these straddles actually are underpriced. In general, they're on the unsexy names that really aren't trading very much, and there's not maybe a lot of activity. So there are some places where you can do it. I think a lot of the stocks that have a story are more prone to kind of beat their straddles because it's so easy to have that 10 to 15, 20% move or whatever when you're kind of a story stock and there's already some short interest, let's say. Like Twitter was an example this week. So that was another one that worked out okay for us. But what's more important is really what you're paying for the straddle and how long do you want to keep it on? Is it a position you want? I think if you're just trying to trade at the money straddles with 3 days to go to expiration, like you said, it's like a 50-50 proposition probably. I think Goldman put out a study where I'm pretty sure I have it somewhere, that if you sold the earnings straddle consistently, if you did it over time, you would lose money. I'm 90% sure that was the finding in it. I've got to dig it up, but you probably could Google, Goldman Sachs earnings straddle paper or something like that and get it. So it's, and I think what people don't realize, or some people do and some people don't, but, options were not modeled for a one-day event. They weren't set up for binary events. They were set up for long-term decaying periods. The option pricing model doesn't work too good on earnings straddles, and it's kind of a crapshoot anyway. So you got to remember that just because that price looks expensive, it's relative to what, and how much of what's the story of the name in particular. So, just because it's a $40 straddle doesn't mean it's overpriced. So I think, but if you start looking around, it will surprise you buying straddles, or at least not selling them. I know Don is probably rolling over somewhere listening to this, but it's not an easy way to make money just because the straddle looks expensive, to answer James's question there. But
I agree with that basic intuition that you can at least start with the assumption of half and half outcomes. So I think getting into the story of individual stocks is a good way in if you're going to trade straddles around earnings. Another thing to keep in mind, something that probably has a lot of influence on how these outcomes shape up, is what the general feel in the market is about the whole earnings cycle in general. So this year is probably a great example of that. You had a couple quarters where, trading the earnings of the last quarter of 2013 and the first quarter of this year, where there were some disappointments and, the data didn't come out as well as people were expecting, whether it was the weather or whatever cause. And so I think that there was a lot of suspicion for the current quarter, which we're in right now, trading off of second quarter earnings, about whether there'd be continued quality in the market, and totally independently of any particular company or earnings story, but rather just in general, whether this economic recovery had enough momentum to sustain itself, and whether you'd see, continued top line expansion, or we're just going to see kind of tepid earnings now that all of the tightening up and layoffs and everything that companies had been doing has kind of run its course. So you saw a lot of names where the earnings straddles were priced significantly above the average post-earnings move over the last, say, 8 quarters. which to me suggests, and then in some of the cases, these are, like you say, Andrew, on fairly boring names that you wouldn't expect to have any kind of big surprise. And so, this is just anecdotal, but I think that there was some sense in which there was a lot of skepticism about this quarter, even once even once we got started, and there was a lot of more surprises to the upside than usual. You had people who were just skeptical of whether or not these companies could sustain the earnings momentum that they had been displaying over the last few quarters. And I think that can drive those straddles higher, just at the margin, across the board, even if there isn't any particular skepticism about this or that specific company. So I think if you combine that kind of top-down approach about what the overall economic sentiment may be with your particular stock-specific take on what the earnings might be and what the expectations might be, that may be a way to get a little bit more of a informed qualitative sense on where you want to pick your battles. But that gives us a kind of a nice segue actually into the question of how you trade and how you think about the profit and loss on these earnings straddles. Question from Eligo. He asks, so should any straddle research into earnings incorporate dynamic hedging into the results? For example, if the underlying doesn't net outperform the straddle, but there are multiple opportunities to dynamically hedge during the trading session, it would be net profitable. Should this be incorporated into any future straddle research, or does this add too much complexity to the equation? So most listeners will probably understand this question, but just in case, when the question refers to dynamic hedging during the session, the idea is that whether you're long or short the straddle, you might rebalance your position by buying or selling the underlying shares during the trading session to get your deltas back to zero, or at least reduce them, and allow yourself to take profits or to hedge against losses during the trading session multiple times. This is something we often see traders doing over the course of a whole expiration cycle, let's say. The idea here is that if you think that presumably if you think that the trading session immediately after earnings are released is going to be particularly volatile, you might hedge dynamically. And so I guess there's kind of two questions that we could tease out of this. Is first, whether we should think about straddle performance and whether it's a good idea maybe to be dynamic hedging within a trading session if you're trading around earnings. And then second would be for the perspective of a research, broad view, should we think about straddle performance just in terms of if you buy the straddle, 3 sessions ago, and then you close it out after earnings, measure your P&L, is that good enough? Or should we also incorporate any profits or losses due to dynamic hedging on the session? I'll give my take on the second part of the question, which is that it does add quite a lot of complexity. It'd be difficult to model and test that, if only because, getting that intraday data, getting it synced with option price data, and getting a reliable, if you're trading in any amount of size, to get a reliable sense of what you could execute option-wise and what you could do intraday, and then to add that to your profit and loss estimate is a kind of an order of magnitude probably more complex than just using daily option prices to get a sense of your straddle performance. And I think too, when you're going to evaluate profit and losses on straddles, if you're really looking at the implied vol in the move, I'm not sure that the dynamic hedging is actually that important, just because so much of the profit and loss, if it's any kind of a surprise in either direction, you'll often see the stock price jump overnight, and then your straddle will be priced accordingly, and you won't have that much trading to do potentially during the day in any case. And all that profit and loss from the straddle will be driven by the after hours move. And in that case, dynamic hedging wouldn't be particularly important. Andrew, what do you think?
I think modeling it would be, and I'm not going to say impossible. Nothing's impossible, maybe, but pretty difficult. As far as dynamic hedging, I think if you have portfolio margin, it allows you to trade after hours to some degree. In general, if you have a little bit more of a move, I would just think of it as sort of, an extra bonus for the position. A lot of times stocks make a big run up. You get to basically dump your deltas out, and then maybe the stock comes crashing down to earth and the trade becomes a giant home run. So there are times that is certainly a viable thing. Whether you can model it or not, I'm skeptical of that. What might be more interesting is, look for cheap straddles before earnings and hold on to them and get a free ride into the earnings cycle. There are several times during the year where this works. It's actually worked in Microsoft about six cycles in a row now, where just because the name is not very exciting, volatility gets cheap, and then the gamma becomes, pretty valuable because, when you're a $40 stock and the volatility is only 19, doesn't take much for a straddle to actually be worth something. So there are different ways to go about it, how you want to trade it. Can you model it? But, generally, if you can scalp, or dynamically hedge, but scalp your straddle, that means the straddle is already outperforming in the first place because it's giving you enough deltas, either long or short, that you actually get to do something. So, my sense would is if the straddle is already paying, it should also work that you could scalp it as well. So I don't know how much that necessarily will help you. Every once in a while, you'll get a decent move for the same token that, the straddle doesn't do anything. And then the next day, the stock might be up $5. You never know. So again, like I said, I don't think it's going to help a whole lot being able to know that you can dynamically hedge above and beyond the fact that the straddle really already performed. So, and that's what you said earlier about term. If you buy a straddle that's going to expire 3 days after earnings, you don't have a lot of chance to trade it anyway. So that goes to what kind of term you pick. And then all of a sudden, now you're, making a Vega bet as well as just a gamma bet. So I think it's a good question. I think it's a broad question. But in general, I would say if the straddle's already performing, it would already be performing if you had dynamically hedged it as well. So,
yeah, this is maybe just echoing what you just said, but it kind of stood out to me. If as a research question, if our goal is to understand, let's say on balance, are straddles overpriced or underpriced or correctly priced ahead of earnings, relative to the volatility and the underlying that we see after the fact. If you were to I guess the reason that the dynamic hedging profit and loss wouldn't be all that helpful is that there's so much path dependency in these short-term moves that if your goal is to say, well, here's the implied vol in these options, you could be smart about that and back it out from forward vol estimates from options that are further out in the earning, that aren't going to be affected by the earnings cycle, and so you could get actually a little bit more refined implied vol number, but it's still this annualized number, right? And even if you try to incorporate profits from dynamic hedging, and you come up with some kind of realized vol estimate, I guess because your time frame is so short, and because there's so much path dependency in where the underlying moves and how and whether it jumps, that I don't know that a comparison that incorporates the dynamic hedging that presumably doesn't capture that is going to be all that helpful. Although it is intuitive, I guess, to some degree to want to have that included. And maybe I'm wrong about this, but it certainly is an interesting question. I really appreciate that, Eligo. And with that, I think we can move on to one of our favorite segments, the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
Andrew, what's going to happen in the week ahead? What's your prediction?
That's such a loaded question.
We call it. I was thinking the other night. We call it the crystal ball. It's just the most audacious and ridiculous segment title.
Well, I think the last two times I've been thinking in vols coming in a little bit, and I've been totally wrong. I keep thinking we would go from like the 12, 13 to back down to 10. I would be hugely surprised now with VIX trading 1689 as we speak, that it is going to be higher next Friday. I would be hugely surprised. The only thing that I would see would be something just awful just happens this weekend, like in the Gaza Strip or something to go awry. But I think basically the country is on the same economic trajectory. You kind of have like kind of slow growth, and it looks really good, then it's not so good. But overall, that's been, pretty good for stocks. And nothing really has looked like to change that. The only thing that's upending the apple cart is a little more hawkish tone, which it should as the economy improves. So again, I still am thinking for volatility should be in the very low teens to the low double digits. Even with the move we've had this week, again, it was a good sized move. It was like almost 2%. But right now, the volatility futures are still predicting lower volatility, and I'm going to have to stick with them on that one.
Yeah, and we talked about the change in VIX implied vol earlier, but with VVIX up in the hundreds, historically that's been a pretty attractive time to be adding on short vol positions in VIX products. So I echo that sentiment as well. It's really hard to see how you would get a higher move in vol from here, especially with the absence of any economic data catalysts or Fed catalysts or anything like that to drive people further away from risky positions. So I'd have to share that bias as well. One thing that we've talked about a lot this year is divergences between small caps in the U.S. and also international stocks. And so I think that that's another place where we might see some interesting things happen this week with sentiment so terrible this year towards small cap stocks. If we get a kind of a bounce or recovery next week, I wouldn't be surprised to see small caps outperform in price terms or at least to come in further in implied vol terms. What about next week and next month at the option pit? What do you guys have cooking?
Well, we're going to start our boot camp. It's August 13th and 14th and 16th. I think we lower the price to like $147 for the boot camp. It's about somewhere between 6 and 8 hours over a 3-day period, learning basically basics, Greeks, the wheel trade, essentially how to sell puts. We have a lot of clients that sell puts, do it very well. Managing positions, managing risk using Greeks, and understanding how volatility kind of fits in all of this, kind of the glue that sort of makes it all stick together. So that will be that's our big event coming in August. I will be at the Money Show in New York on September 12th, talking about condors and butterflies. And, basically when are those trades, nice trades, when do they work out? What are the conditions that make them work? So join me there in the Money Show in New York. And those are for the month of August and the month of September, that's our big action.
The condors and butterflies thing, that sounds really good. People should check that out. That's a really good topic. For my part, we came out with a couple interesting notes I thought were interesting this week, looking at some of those strange occurrences in skew that I mentioned at the top of the show. We had another issue of Volatility Tracker that dropped recently. And as always, there's more things cooking, looking into some shorter expiration options these days, as well as some of our bread and butter VIX strategies as well. So check out Option Pit, check out BGC Partners, and thanks everyone for listening. As always, feel free to send in your questions, and I think Longo should be back next week. But until then, keep trading vol. Bye-bye.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.